I'm going to rush through one pack of slides that we missed a couple weeks ago, and then we'll get back onto this one here. We're going to recap what we've talked about a little bit in the past. So we're going to move on fairly quickly, but you can refer to some of these things in the book if you like. So, as you'll remember, we talk in three phases. The financial planning stuff we've already talked about, the diagnostics are all in the book and the checkbook. Check off if you've got all these items done. Then we get to the middle portion of reallocating, reevaluating the portfolio. And what makes a good portfolio? We haven't spent enough time doing that. There's a lot of work to it, but you can read through the book and figure out how you want to do that. It has some examples. And then the third part we'll touch on a little bit today is the follow-up on monitoring the investments, the portfolio, and the estate plan, because things change. We lose one, maybe two clients a month who pass away. Most of them are in their 90s or 80s, but sometimes things happen. So we'll touch on those. But we're going to come back briefly and hit why an exchange-traded mutual fund. Internal diversification of stocks and/or bonds, dividend reinvestment, most of them will let you reinvest into themselves, access to the market sectors and areas that you normally wouldn't have. So diversification is key. We don't want to have all our eggs in one basket, but diversification will kill your returns to some extent. I mean, if you want to have the top dog all the time, you're going to have to guess what human behavior is going to be the next day. And we can't. So I'm assuming we don't want to lose what we've invested and get a general rise in value over time, but not have to gamble on what the market's doing. These are the indexes: Dow, S&P, Total Market Index. That's just a collection of stocks that people publish, and you can see what they're doing today. The Dow is down a lot, but the market's been up for a while, and again, that's a short-term pause. Non-index funds passively managed. So if you buy the cheapest fund out there, it's a S&P 500 total stock, total bond, really low expense ratio. The downside is maybe some of those stocks aren't all that great, and you don't want to own all of them. So you go up to the next step in the pyramid, and you might pick some non-index funds that are passively managed. Some are called smart beta. You'll have this on page 167. Strategic beta, multi-factor, minimal volatility, low volatility, buffer funds. These are all different exchange-traded funds that you can buy that have kind of a theme. This one might be a theme of we're only going to do solar or specific areas if you want to load up on that. ESG, environmental, socially governance. Buffer funds are some that try to reduce the downside risk by buying some. Do they buy options?
They can.
Yeah. The buffer funds and that. Okay. Low volatile exchange traded funds, low volatile stocks, old stocks that have already hit their peaks that they tend to not go up and down quite as much, but they might pay a higher dividend. Minimal volatility, ones that have less risk in their category, but they have growth potential, and so on. So the bottom line is total index, forget about it, but you're getting one of everything. The next level is a little bit passively managed or allocating for what you want to do. Smart beta would be looking at stocks that have beta or risk that is reasonable for what you're buying. But there's a strategy that they do, and then the other indexes are the bond aggregate and Dow and so on. So again, these are exchange-traded funds. I call them exchange-traded mutual funds. You'll see this in the book. There are structures, different types of structures and things that you can buy them. But the nice thing about the ETF is that you can buy it in your brokerage account and purchase it fairly quickly rather than wait until the next night. ETFs usually, but not always, have a low expense ratio. Nash has got one that's as low as 0.015, an index fund. But we've also seen them at 1.4, actually up to 2%. So it's not an assumption. You can assume if you go to Vanguard, they're all low cost. I've never seen them gouge anybody. ETFs are obviously a wave of the future. The other elements is what is the index or sector you're going in, the securities in the funds. These are all the things that Nash will look at in a portfolio. Allocation of the fund itself. Does that mean what you're looking at, strategies the fund follows? You know, a lot of people say, what's a good fund? Well, I don't know. If these things meet what your objective is, then that's a good fund for you. But just because a fund's up a lot just means that everybody ran over to see that fund and to invest in it and think that they could make some money, short term. Some of the greatest investments have been way up and way down. Some of the worst investments have been way up for a little while, right? Remember GameStop and all that kind of stuff. So we want to be careful not to follow the crowd of everybody's excitement. AI's been around since, from what I recall, 1968, right? Remember HAL, the computer that took over the spaceship in 2001? So I'm sure it's taking off more now, but let's not just follow everything and buy an AI fund. They're all advertising AI fund. It used to be they advertised ESG and cannabis and all this stuff. That's fine, but either get in early and take your chances or wait for it to fall and be a second chance investor. Maybe Tesla will come back, I don't know. Tracking error, that'll be in the book on page 82. And then is the fund leveraged, meaning does it take on debt? Well, Nash corrects me on that. Leveraged funds don't necessarily take on debt.
No, they can, but oftentimes what they'll use is a leveraged security in and of itself, like a futures contract or an options contract, in order to achieve greater returns.
So we need to stay away from 2x, 3x funds, unless you're an expert and you want to gamble. And from what Nash has taught me, they might be really good for 2 days, but you don't want to be investing and just waiting it out because you'll end up crashing. There's a lot of problems with that. More about exchange-traded mutual funds, fixed income securities. We know those are bonds, and they lack liquidity if the market got real bad and somebody didn't want to buy your bond. So if you buy a bond fund or an exchange-traded fund, there are several different bonds in there. You have a little better chance of selling your shares than if you have one bond nobody wants at that point. And it's been proven that when we've had flash crash and other problems, the exchange-traded funds were very liquid and it wasn't a problem. Minimum assets under management. I don't know, is there any figure that you like? I always say 100 million, but
It really is going to depend on what we're talking about. Like if we're talking about a pretty generic fund, I want there to be a lot of money in there because it'll be cheaper, because there'll be a lot more people pay for it.
Yeah.
But if it's something, if it's a really specific sector or something new, I don't know, I might want 50 million, but again, it just kind of depends on what we're looking at.
yeah, and if you find a new fund out there, it might have higher expenses because it's like $500,000 just to run it, not including all the expenses and the salaries and things. And some of these off-brands, they're not off-brands, but Invesco and Wisdom Tree, they're good companies, but they'll take the time to set up a new kind of fund that does something different. And the expense ratio has to be higher, 0.5%, 1%. And if Vanguard and Fidelity and Schwab, they're not going to get into it until it's very popular, and then they're going to come in and take everybody's business. They're going to come in and swoop in and say, okay, we're doing this now, and then everybody moves to Vanguard, and these other people lose clients. But they start with a higher expense, and they'll do specialty areas. But if there's only $2 million in it, nobody's buying and selling it, how are you going to get out of your shares, right? So Nash will have a minimum that I'll go, hey, I love this fund, I want to do it. It's not enough volume in there of buying and selling, there's not enough money, it's not worth the risk. But my theory is if it's through Fidelity or Schwab, at least I know they're going to back it up, they're not going to do something wrong, but they can close it. And if they have an exchange-traded fund that you have that went up in value and not enough people liked it, they can close the fund and send you your money back. Now, what's the problem if you buy an exchange-traded fund that did wildly well, but not enough popularity, or maybe they all went to Vanguard, this fund didn't raise enough money, you made money in it, your shares are worth more, but now they have to close it. What's the problem? Taxes. They sell the securities and send you the cash. That's an issue. So if it's something that you think is going to become popular, great, but I'd stay with the big companies unless you find something with a small company that only they do, and you really want to get into it. They're not going to they don't want to go out of business, they want to keep you going so they get their management fee. There's different types of orders. I'll let you go to page 86 that it explains a little bit more how you would buy these, because exchange-traded mutual funds are bought and sold very similar to stocks, and so you have these different orders in place if you get into it. Exchange-traded funds, taxes, they can trade stocks among each other and delay or not pay any taxes. So it's kind of like if I set up a big fund and you put your real estate in it, and I trade this real estate for that real estate, you own a share of all the funds, but when I trade it, there's no tax liability, nothing happens, like a 1031 internally. Although in the fund, they don't pay any capital gains, even when you sell the shares on those specific shares of the stock. If your shares went up on the exchange traded fund, you would pay taxes at that point. Bottom line is, outside of a retirement plan, an exchange traded fund is very tax efficient. So you're not gonna get them rolling money over just to sell this and buy that, and then you pay the taxes like a mutual fund will do at the end of the year. They'll trade it for another stock that doesn't have a lot of tax gain in it. And so they're more efficient and help people in that way. They can create income from buying and selling options, but I wouldn't go in that direction. But some of them might list, we have this expense ratio, but the net expense ratio is lower. They might be renting out your stocks to make money, and that helps the fund reduce their expense ratio. That's a possibility. Risk matrix, we talked about this a little bit in the past, but the Sharpe ratio, I'll just generalize it. It's a risk-reward ratio relative to the fund in its category. So you want a positive number there. You'll see that on page 94. Sorrentino is a downside deviation. Does that sound right, Nash?
I'm not familiar with Sorrentino.
Okay. It's similar to Sharpe in that. Beta, we talked briefly about the risk relative to other funds in its index. Alpha is the return over the risk adjusted for the benchmark. R square is how pretty much similar it is to a benchmark or something. But if you create your own portfolio, it's nice to know what the ups and the downs are, bottom line. What's the historical volatility from its average? If it's way up and way down, that either works for you or it doesn't. It doesn't mean it's a bad thing because it might have a lot of growth potential. Right now we're enjoying growth funds that have technology funds in them. Yay, this is great, but a year and a half or two, they weren't looking so hot, right? They were in pretty bad shape. But at that point, we moved money into them because they were down so much. And then now we're starting to move money out of them. Interesting point today, the stock market and bond market's all down except utilities. And that's weird because utilities are almost like long-term bonds. They have long durations. They should be down if people think interest rates are going up. But maybe they don't think rates are going up. Maybe they think they're going to stay the same. That's a weird thing that would be interesting to watch the economy.
Are there any programs that you can use to plug this information in when you're evaluating funds that you might be interested in?
The one that I use is, what is it? Morningstar Advisor.
Morningstar Advisor Workstation, but Morningstar Investor is basically the retail version of that, and it's about as good. And if you might have seen one of our emails, we sent it out at the library part, but we have found some ways that you can get it much cheaper than buying from Morningstar directly. So from them, it's like a pretty expensive monthly subscription, but you can grab a library card from another state for like $35 a year.
I'm sorry, where are you getting that library card?
It's in one of the emails that we sent out from the class.
Okay.
So if you look back through there, you should be able to find it.
Okay.
And if not, a connection sheet, which you can help you out.
Yeah, we can send one out again.
Yeah, I can send it
after this
up.
class. Yeah, however that works.
Okay, great, thank you.
Morningstar. And then when you plug all this stuff in, you want to see if everything works together. It's like putting an engine in your car to rebuild. You want to make sure all the parts work. And what is right for one person isn't so right for somebody else. Morningstar is really good to evaluate the funds for you. You can lose money immediately. Oh, gee, this is up, and Morningstar likes them. I'm going to buy it, and then it goes the opposite direction. But they'll have stars that represent historical returns, more of a numbers, where are you on the list. They don't pick the stars, that they tell you where the fund comes in compared to its category and things. And then you have silver, bronze, gold rated. And it's not that they think it's going to go up, but it's run properly. You have good parts.
Fundamentals.
Yeah, so all the parts to the machine look like they're in pretty good shape, and then it's up to you to put them together. You look at the bond duration and credit risk of the bonds, yearly yield versus SEC yield. Those are two different things that you want to learn a little bit about. Diversification, obviously, and capital gains exposure, if it's a non-retirement plan. And then exchange-traded funds, this is interesting, and funds that your old retirement plan might not offer. There's tons of people out there trying to get you to roll over your old retirement funds, right, into their annuity. Whoa, so good, yeah. a tax-deferred vehicle to a tax-deferred vehicle. That's highly inappropriate. They probably could get in trouble for that anymore. That's good. But you may have a big 401k, thrift savings plan, whatever, 403b or something at your old employer, and you do want to roll it over to a rollover IRA, right? Don't combine it to a small non-rollover, liability issues. But if you do that, it has to be worth it because your old 401k plan probably has some low-cost index funds, and they'll keep doing their part to try to give you the best quality because they can be sued, right? So if it's the thrift savings plan with the government, you have some of the lowest cost index funds you can get. But they don't have a lot of variety of things. They'll have the small cap, large cap index funds, they'll have some target funds, international index and that. Those are fine while you're buying because they're up, they're down, and it's more for growth, right? Some of the target funds might have more bonds and they change the allocations as you get older, but we learned 2 years ago target funds took a major hit because they were buying long-term bonds. And they balance the percentage of bonds in the portfolio to the S&P or total market, but that percentage of bonds, those were long-term bonds, and you took a major hit. And in the book, we talk about we don't like target funds because you can't target a target fund. If you want to pull some money out of it, you have to pull across of everything. What if the bonds crash, then you pull money out of the stocks? What if the stocks crash, pull money out of the bonds if you needed money? So target funds are okay if you have no other option, but you can't really manage them for you. These are some of the funds that you don't see in your company retirement plan. I don't see, pick a, let's say, Vanguard Utility Index Fund. Don't see it in there. Utilities are nice because you have a big dividend. They're somewhat reliable. They're volatile like bonds and the stock market. But today, they're up. They're the only sector that is up versus, I think, maybe oil or something. They don't have energy funds in there, oil and gas or natural gas, that's fine, because they don't have them, because if you gamble on one of them and lose, then you might sue them, right? And not enough people will be doing it. They don't have them in commodities and in real estate. Real estate's at a low point. Not all the real estate stock funds are buying residential houses or office buildings. They're buying cell towers and other things. It might be a good time to look at real estate funds that have stocks in it and slowly start dollar cost averaging on the way down. Or wait a while, but by the time they say it's time to buy them, the price will go up. So you won't know. But again, another risk. Low cost index funds, not all retirement plans have total market index and small cap index and small cap value versus growth. They will have some index funds in there. Smart beta, the ones that are picking the risks to try to reduce unnecessary risk, strategic beta, things that'll diversify a little bit better, multi-factor funds, minimal volatility, all these funds, ultra short-term bonds, floating rate securities. Floating rate income funds are paying like 7.5%. But you know enough to say, well, wait a minute, what's the catch? The catch is you're not getting 5, you're getting 7.5 because the credit rating of the bonds are less. They're very short-term maturities. They mature really soon, 30 days, 60 days, a year. So if interest rates go up, they don't get beat up, but they're low credit rated, so if everybody gets scared, their values can drop because you're afraid that these are lower credit rated loans. Are these people going to pay me back? So occasionally when you have a significant downturn, floating rate funds can be scary. But generally speaking, people are bragging about high yields. Short-term bonds, Ginnie Maes, you don't see most of these types of investments in your retirement plan. They try to keep it simple, right? So if you are choosing to roll it over to your own brokerage account as a rollover IRA, nobody's going to question that, you're doing it. If you hire somebody to do that for you, he or she is questioned, why are they rolling these dollars over? They've got to prove that it's better for you to have a variety of these funds that are more designed for passive investing and not adding to it, let's say, versus where you were, where it's a dollar cost average environment. These funds all pay a lot of dividends, so if the market falls, most of them are replenishing the shares by reinvesting dividends. 401k plans are more designed for people adding to it, so if the market falls, you're dollar cost averaging, and it's okay because you're buying cheaper shares. So if you transfer over to somebody other than you, they need to justify why they're rolling it over and what benefit you're going to get from that. But obviously, stay away from the insurance products and things like that. Fund broad market parameters, you'll see that on page 105, an index fund versus a managed. Depends on what it is. If I want to have one of everything, stay with an index fund. If I want to go into one of those new Bitcoin funds, maybe I do want a managed fund by some expert on Bitcoin, obviously, right? Soon there'll be an index digital currency fund out there. And there's tons of funds coming out every day, right? Everybody wants to come out with a new fund and have it grow as big as possible. They needed to go very big because when in the old days you charged 2% management fee, or some of these high risk ones could charge it and make a lot of money. Now the expense ratio the investor is expecting to pay is 1/4 of a point. And so they have to grow this thing very large to bring in the money to make a living, right? Or do something so unusual that it attracts attention. But when you do something like that, it's a higher risk because it's, let's say, cannabis several years ago. Oh, everybody's wanting to buy cannabis, and now you don't hear about it at all. So we want to be careful to follow these things. Page 105. So again, there's that risk parameters, expense ratio. The other class that we have, Nash talks, and you can watch him talk about it, the modern portfolio. I'm assuming one of the classes covers that on the website. So you can go to our website and watch the first 7 or 8 classes. 7?
I think 7, yeah.
Okay. Yeah, so you can go and watch at home. Nash teaches those classes that are very much in depth on the risk parameters and Sharpe ratio and modern portfolio. Other parameters that you want to look at is the positive correlated assets to each other, but then you want some that are opposite of each other, non-correlated, and so on. Income producing funds that are reinvesting. Because when you go from an old retirement plan, if you're working and adding to it, you're doing that dollar cost average concept. Doesn't guarantee a return, but it helps you buy when it's high, when it's low, and emotionally lets us get through the tough times. When you have a lump sum of money you're no longer adding to, it's a good idea to possibly rebalance it if you're concerned about it going down in value, because the market could crash 2008, right? And we didn't fully recover for almost 10 years. Now, if you had funds like this, that other slide, were reinvesting and healing back the wounds, by the time the market came back, they were in great shape. But if you have non-dividend paying funds, if the market tanks, you have to wait for it to come all the way back to the beginning, where it was. So if we're getting close to retirement, we're adding to the stock funds on a regular basis, but the old money that's still in the retirement plan, maybe move some of it over as though you're older and make it more conservative, or roll it over to an IRA. So if I've got whatever dollar amount, 300,000 in my 401k, I might move 250 over into a balanced portfolio that's going to survive the markets, but I'll keep adding into my aggressive stock funds, small caps and large cap and all that kind of stuff. That way, if the market tanks and doesn't recover for 20 years, then you've got your large portion that you've accumulated that survives that and is a little more stable. And then part of that has short-term money in cash and short-term bonds. Some of it is intermediate term, can take some bruising, some of it's stock. So it's kind of like managing it for what your situation is, not what I think is going to happen tomorrow. If I tell you I think whatever stock or sector of the economy is going to go up tomorrow, what I'm trying to do is predict human behavior, right? The same thing as if you're a buyer for a clothing store. You have to predict what you think people are going to buy this next season, and they may not. So the stock market, in some short period of time, is just trying to predict human behavior and what they think will happen if something else happens in the world. And there's always crazy events that happen, and the markets always recover. I can almost guarantee the market will keep going up in the long term. I can't absolutely guarantee it because that's ridiculous. I don't want the liability. But the reason that I think it will keep going up is not because it's so wonderful, but because human beings, there's more being born every day. Not good for the planet, and there's other issues about that, but the more people that are being born, you have more consumers of goods and services every single day. Now that's a tragedy in some senses, but it's reality. And you have more countries coming out of poverty into middle class and wanting their Tesla. They want their cars. That's a whole other thing for the planet. But as far as the stock market goes, even when it tanks, people have to come back, and we saw that during COVID, right? Everybody stayed home, but they gotta go shopping and get food. They gotta go do the things they wanna do. Sooner or later, they come back, and some of these areas recover. So these are just some of the things to look at in the book at page 105, or watch the other classes that will go into that in much greater detail. And then some people say, here's the allocations, funds that represent stocks, conservative, 20%, 80% in cash and bonds, or at the bottom, the aggressive investor has 80% in stocks, 20 in cash and bonds, and the aggressive investor only has the 20% in cash and bonds for buying opportunity. When the market tanks, then they can buy into whatever's down. So if you think the market's going to recover after today, some tech stocks individually, but funds are probably down 2.5%, 3%. So your cash in that portfolio, if we keep going, and the problem is we don't know where the bottom is. So you could say, look, I'm going to take, of my 20%, I'm going to invest 5% of that into whatever part of the market's down. And then if it keeps going, invest another 5%. And at the end of using up all that 20%, we hope sooner or later it comes back. And if it doesn't, you just have to wait it out. Then there's other financial planning issues, but these are just some examples. And just because you have 80% stocks, 20% cash, Nash can find funds that are in stock that are fairly conservative and stable. And he can also find bonds that are crazy risky. So these aren't absolute numbers, but they give you an idea of what some people do. And sometimes in your company retirement plan, or if you have an advisor, they ship out the management. You sign all the forms and they say, are you conservative, moderate, or risky? They send it to the home office, they take your money, and a computer, based on what somebody's designed, creates a model, and you're invested on that model's objectives. We don't believe in that. We think you should manage the money by yourself, learn everything there is to know, or if you have somebody do it, they're really into your risk parameters, your liquidity needs, your financial planning, and then they need to pick the funds themselves. Because we're constantly changing funds when another one comes out. And we'll show you briefly how to do that. So again, those parameters and some of the other details that you'll see on page 116. Okay, so I'm going to go out and come up to our class that I should be doing today. Any questions so far? That was kind of the rush. Shaniqua, how, if anybody's interested, how do they get involved with Renaissance?
I think the easiest way to get involved with Renaissance is either to visit our website and click on Resource Center, and then we'll have it's called Active Retirement Investing, but it's a 12-week. You can click that link to go to Renaissance, or you can Google Renaissance at Sac State, and that'll bring up their website, and then you can browse the spring catalog so you can see all the classes that they offer, and then you would just sign up and then choose Active Retirement Investing.
It's fun. You go out on Friday at Sac State. I go early, hang out at Starbucks, and watch the kids walk around. Remember what it was like to be in college? I used to walk around barefoot and all that stuff. So it's kind of fun. But the other classes are completely the opposite of this one, so they have some really cool Bob Dylan class. I don't know how you study Bob Dylan for 12 weeks. And they have all kinds of stuff. But it's stuff that people want, so they have fun with it. So if you have Fridays off, that would be fun to check out. Like I said, you can go to our site, look at the videos of the class, and get a feeling for, is this what you want to attend? But even 12 weeks, we barely touched on things. There's a lot of information there. But, and this book is like 2 years old, but it should be up to date to get you started and read through everything. And there's a readiness list at the back of the book to make sure that you have all the basic details. Because it's our opinion that what's the point of investing if you lose it due to an accident, an illness, a lawsuit, or you die and leave it to the wrong person? What's the point? So financial planning is more important than the investment process. It's just that the investment process is more fun and stressful, but it keeps your attention. So let's look at, we talked about the financial planning stuff a little, we skimmed through the exchange traded mutual fund and portfolios somewhat. Now we're going to look at the monitoring and tying it all together. What do we do at this point? And again, this is all in the book for you to do homework. There's some things that most financial plans don't cover unless you need it. Social Security income planning, that's another animal, although there is a very special article coming out on the wire soon.
Soon, yes.
Okay. On that Save Our Social Security that we wrote, so I'll either get some really nasty emails or not. But you need to do the planning for you to choose the right options someday when you do go into Social Security, if we have it. And in 10 years, it's scheduled to drop like 25% unless the politicians change for everything. We didn't talk about charitable gifting and health savings accounts and things like that. But if you have the option to do a health savings account or any relative or friends, encourage them to do the maximum in there. I've got mine now built up to where it's like my vision and dental fund. But it also covers deductibles, but I don't have deductible because now I have to do Medicare. Although I paid the same amount as if I was buying insurance somewhere else. Amazing. When you've done the financial planning, portfolio construction, and now we look at what do we do after the fact, here's some things on the right side. Daily, we want to watch what interest rates are doing and politics are doing. It's not that you can absolutely project and guarantee that the Fed's going to keep interest rates the same, but most likely they haven't dropped them. They said they would and they didn't. When they said they would, the market went straight up, and now that we're realizing they're not, the market's starting to go down, right? But there's a lot of money on the sidelines. I hear that there's like $1 trillion in cash waiting to be invested, so they're waiting for some good news. But the market's gone up a lot in the last several months anyway. So keep an eye. We knew to stay out of long-term bonds for the since I got in the business in 1982, because I watched long-term 30-year treasury bonds. One lady bought $100,000 for her daughter. The daughter earned like $5,000 a year, 5%. The very next year, somebody else buys the same treasury and earns 10. They earn twice as much. Or the first person invests $100,000, earns $5,000 a year. The next person at 10%, rates went up, could only have to invest $50,000 to earn the same 5%. So I experienced that. So we stayed away from long-term bonds and even intermediate-term bonds. We're slowly starting to look back at it. But still, we stayed away. Unfortunately, my bad experience, I didn't have much in the market, but I learned that to stay away from long-term bonds. Now, pension plans have to buy long-term bonds because they have to predict what income will be for paying out. We stay away from that. It's kind of like being in real estate. Stay away from adjustable rate mortgages if that's going to hurt you if rates go up.
Different long term, like 10 years or more.
I would say that would be long-term for me. The longest would be 30, but 10 to 30 years would be long-term, yeah. If you, let's say there's a senior citizen that saved up $1 million and that's all they have, and she needs to guarantee her income, well, you don't want to buy an annuity, so you buy a 30-year treasury bond at 4.5%. She gets, if she had $1 million, $45,000 a year, state tax free if it's treasury, and that's nice. And inflation is going to affect that, but she's maybe not going to live that long, so she can live off $45,000 if she dies. She leaves the money to her son. Okay, that's fair enough. Inflation could go up, make it not earn as much. She's a good candidate for buying a 30-year treasury bond or a bond fund because her problem is, what if rates drop down to 3% and she was getting 45? If she gets a short-term T-bill, now it renews at 3%, she's hurting real bad. Stock market went up, but she didn't have money in the stock market. So some people that need to project and guarantee their future income, like pension plans or senior citizens, they might do that, and then she can laugh and say, I don't care if this thing drops in value, I want the money. That's my son's problem. He can sell it at a loss. But generally speaking, we recommend staying away from long-term bond positions, unless you think interest rates are an all-time high and they're going to do nothing but go down. So that's daily. Weekly, we want to follow fund alerts. If you have some funds in your portfolio, it's a good idea to track them. Maybe find an app that will let you know what's going on. Morningstar might do that. But if you have a fund that is doing a little bit of management style and things, it's nice to keep an eye on them in case something goes wrong. Or maybe that person's in the middle of a legal battle or a divorce, and they're not focusing on the fund if the fund needs their focus. So you can hear all the scuttlebutt and just Google it occasionally and see if other people still think the manager's doing a good job. Because to this day, I don't know what makes a good fund. Beyond low cost or reasonable allocation or good management and everybody's doing a good job, everything's a guess from this point. So if we've got one fund that went way up and that person's real popular, what's that lady's name, Nash?
I'm blanking on it, but she runs the ARC funds.
I think it's Kathy Woods,
Oh, yeah.
Woods or something. She was really popular and made tons of money because she put her biggest positions in
Tesla.
Tesla, and Tesla was going straight up. She's a hero. And Tesla tanks and other things tank, and now not so much, right? So you're paying somebody else to gamble your money, and that's okay. If you just don't have the courage to do it, let somebody else take the big risk, but they're going to take it with your money, right? So nothing wrong with that, but if you do have a fund that on the pyramid is managed and they're buying and selling, then you want to track what they're doing and see if they're following that industry. Sometimes we call that tracking error. That may or may not relate, but you want to see how are they doing and are they staying out of trouble. You don't want to find out the SEC's after them and there's all kinds of problems. But if you want to just get a big index fund, just go with the big four companies: Vanguard, Fidelity, Schwab, iShares, right? Other companies are good, but they're not quite as big. So weekly, follow the alerts on the funds. Monthly, screen all the mutual funds and the index funds and everything. If you're doing this yourself, if you can get on Morningstar, and if you have a list of your funds, screen them and see which ones have the highest expense. This one that does preferred stocks has really good performance, 5-star, gold rated, but their expense ratio is high. Is there anybody else out there that's got a new fund and the exchange traded fund platform that maybe does the same darn thing but a lower expense? Okay, fine. I can replace the old high cost to a lower one. Or maybe I look at all the funds and I've got too much money here because it's grown and the other ones haven't. I can rebalance it at that point. Or maybe it's gone from a 5-star down to a 1-star with Morningstar. That means it's at the bottom of the bucket on performance compared to others in this category. Or maybe it was a gold star or silver or bronze and now it's a negative. Well, we want to find out why, and you go search the fund. So monthly, we'll line up all the funds, but the primary thing on a monthly basis is we're going to go shopping for new funds. Is there any other exchange traded mutual funds that can replace our old managed mutual funds that have higher fees? Or there's new exchange traded mutual funds that we would like. So we'll go shopping on a monthly basis to replace the old inventory with the new inventory. And that may work out for you. Quarterly is when we get a little more specific about lining up the funds and finding the ones that have the highest cost, the least performance. The 5-star has dropped below 3-star, and then the whatever Morningstar says that's good or bad about the fund. If you subscribe to Morningstar, don't subscribe to them or anyone else thinking they're going to give you tomorrow's winner, right? They're just going to tell you that the motor is built out of really good parts and this race car is all ready to go. But they can't guarantee that you'll win the race at that point. Biannually, we want to line up all the funds and find out which ones are the highest return for whatever time frame you're interested in. And it might be, at one point, I think utilities were up 32%, but the general stock market was only up 23 or something. And if it's an outlier and it's like, whoa, this is a lot for utilities, then we'll sell off whatever seems to be peaking and buy into another area that's a good fund, but it's just at a bad time. So if I were to do it today, if utilities are up like 10 or 12% for the last year, when some of my clients that we added some there, if it's up too much, I'd sell off of the utilities and buy into technology or growth funds, right? I wouldn't actually do that today, but if it was utilities were up radically, whatever you think is up and you think I'm pushing my luck, just take some out and then buy another fund that happens to be down today that is a good area of the economy for whatever reason. Tech stock funds, I assume after today, are going to be down a lot. If you haven't done it before, you could be moving into tech funds as they're falling. But it's never easy because you're always having to buy something that's on its way down. People don't like it. That's counterintuitive. Why would I buy something that nobody wants? But yet in real estate, people do that, and someday they work, things turn around and things get better. Or they fix it up and whatnot. Annually confirm the investor or the client's needs for their goals and objectives. So you should start all over again and looking at this stuff. So daily we're watching politics and interest rates, things that are somewhat predictable. Not to say that you're going to gamble on the stock market, but if it looks like interest rates were going to start falling, then you might buy, they haven't really done it much, but let's say an overpriced a priced house that had dropped. You buy it and get a higher mortgage and then refinance it when rates fall. Right? Or you might buy, if you think rates are coming down because the Fed's hit a peak, then you could buy a little bit longer term bonds. But daily is the news, weekly are looking for new funds, weekly is alerts, monthly is shopping new funds, quarterly is screening old funds to try to replace them, biannually what's up too much to reallocate, and annually do the whole financial planning process over. You may have accumulated a fair amount of money by now, and then you've decided, I don't need to be so aggressive. My stomach hurts when the market goes down because I have all this money built up. So then you might tone it down. Or, I just started Social Security benefits. Wow, it's a lot more even after if they cut them, and my rentals are kicking in or my other stuff is great. This money's really for my adult children or grandchildren or other relatives or friends. Now, since they're much younger, I can reallocate that into a more volatile portfolio. Because long-term volatility is your friend. Short-term, it's your enemy, right? So if you look at this stuff every year and reassess each investment or each account, you might push one to the side if it's not for you and for someone else or something else. Then you don't have to worry about it, and you can get more aggressive on that if you want. But that's where we make our biggest mistakes, is we get in and out of stuff. Out of fear and predicting the future. We think the market's going to go down, and I've seen obviously people get out and then the market went up. So we don't want to go with emotion, or write yourself in a diary where you want to be or where you want to go when the market falls, and then read your notes when it actually does fall and see if that was a good move.
So I know this is pretty simplistic, but so you don't sit yourself and buy a fund, if it goes up 30%, have like a reminder, sell and lock in your profits. Is that something that you would advise against or advise?
I would advise for, but it's more of a behavioral investment pattern. It's not going to turn out to be, oh my gosh, you did everything perfect. But it worked for you, because if it does go up more than X amount, it might be a good time. And you could Google, what's the highest peak of utility stocks on average. And somebody will write an article, and then you might say, if it breaks out of 10%, I think I'll sell some of it. Break out.
So that's just a rebalancing process?
Yes, absolutely.
Okay.
Moving averages and anything?
Not something that we use at all. We don't use any technical indicators in our practice, because the only thing we're focused on, we're not, it sounds, it's difficult for me to describe, but we're not a trading firm, right? We're a risk management firm overall. The main purpose of our investing strategy is to use the historical statistical information that we can to put the portfolio into a place where it will, out of 97 out of 100 scenarios, end up in a position where it funds the overall goal. So it's like, instead of rather trying to play these games where we try and maximize profits or whatever, it's more about putting ourselves in a channel that takes us to that.
It's not short-term profits,
right? It's not
just
short-term
long-term
profits.
growth.
So, like, there are obviously things that you can do. I'm sure there's a lot of traders out there that would have advice for you, but that's just not something that we advise on, because if we're in a position, we're in it because it makes sense on a huge basis of data and like many millions of points of statistical information. That's why we're using it, not because we're expecting some sort of insane breakout and targeting a specific price level.
Yeah, you hear a lot of advisors. I remember in COVID, one bragged about how they have a timing service. And, well, how are you doing now? We were out of the market. We were out. We missed all that downturn, right? But they don't tell you that when the market moved up quickly in any given day or so, that they weren't in the market. And statistics show that if you miss 1 or 2 or 3 of the top trading days, you miss out on everything that year. So we're looking at more diversification and financial investment planning for you versus trying to say, look at what we did. Because we can always pick a fund. Utilities. I've been buying utilities for the last year. Oh, I'm finally right. But it was just that they were down so much, everything was up too much, And we were just averaging back into utilities a little bit, and that's fine. But if I wanted to gamble everything, I would have sold everything and bought utilities. That would be irresponsible, and it would be a risk for us to keep our license like that. It just wouldn't be the right thing. So if you gamble, you gamble.
I'm thinking, isn't the behavioral model that you're describing, you see something that you think may sort of peak, sell out, buy low. So you're sort of selling high and buying low in a good sense as opposed to bad. But isn't that triggering a lot of taxable events? So if you're trying to manage yourself for taxes, that starts to get to be kind of dangerous.
Yes, and you can do tax harvesting at that time if you have any other positions that are down.
Right.
And then if you sell them, buy something very similar so you don't miss on the upturn. But then you reduce your cost basis so you'll have a little more profits. Yes, if it's not a retirement plan, you want to be very careful. And it's also doing the same behavioral stuff we said not to do. You know, if someone goes up to, oh no, sell it, buy some of this down, well, same thing. But it's more in managing the risk and the diversification of the portfolio, not trying to predict. But yes, when you reallocate a portfolio, Nash, you look at the cost basis and everything.
Yes.
Okay,
So when you're doing that, are you I guess I presume you're simultaneously saying, I'm gonna sell this one, I'm gonna buy in here, but you're gonna calculate a tax impact, and then you're looking around to say, can I mitigate that impact, and if I can't, maybe I won't make such a big move. Is that kind of the way you think about it?
Exactly. On our trading ticket, if it's not a retirement plan, and if there's more than $3,000 capital gains, I have to call the client and say, I want to sell this fund. I think it's going to tank. I think it's worth paying some capital gains tax. I don't have any other things to reposition to offset the loss. How are you paying X amount of tax? But we don't do it without checking with the client. They will not be happy.
You sort of automatically take just a chunk of the gain and stick it into some sidebar place in cash, so that when the tax payment comes up, the person doesn't have to come out of pocket because you harvested some of that taxable amount and stuck it in a cash investment.
Absolutely. We usually don't have massive tax hits on something like that. We started off in a proper allocation, and we're not so heavily invested in a high risk investment that it doubled or tripled overnight. We've got a problem. But a few years ago, we do have some people, we bought an energy fund, it's up 3 times. So we have to sell off a little bit each year to stay under the radar. Because at what point, what income bracket do you pay capital gains?
It depends on your ordinary income tax bracket, first of all, and then that'll determine what you pay for capital gains on a portion of it. It kind of gets a little complicated, but I think 2024, you have to make 94,000 in gross income before you start.
Joint income?
Joint, so I don't remember what it is.
So if you are, let's say 2 people filing jointly earn less than 90,000, if you earn 80,000, then you've got a little room in there that if you sell off, there's no capital gains, but beyond that, then it kicks in at 15%.
Right.
Yeah. So, and this is the other thing. If you work with somebody else, they need to say, I want to rebalance this. I need to sell this and buy that, but if it's going to be a lot of gain, then you call the client and say, this is what I'd like to do. Are you okay with some write-off here? Some people have old losses they carry forward every year. You can write off $3,000 a year off ordinary income and other old losses if they're the same as what you would sell. And that's why you need to watch this very closely, or if you have an advisor do it, he or she needs to be doing it themselves. Because the bucket or the model portfolio people, they don't know this stuff. They don't know what your tax situation is. They don't call you.
Can you compensate long-term capital gains with short-term capital gains?
Can
Sorry,
you
losses with gains?
short-term
Yes,
loss
so-
versus long-term?
Short-term versus short-term always gets netted out first, but at the end of the day, if you just have a short-term loss and long-term gain left, it still nets out.
And if you have short-term gain and long-term loss, can you do the same?
Yeah, you can, so with capital losses, it really, like, at the end of the day,
It doesn't matter.
it doesn't really matter until you get to just straight gains.
Gains,
Like,
I see.
and then short-term gains, ordinary income rates, long-term gains, you'll pay long-term gains.
Okay.
And then with capital losses, you have 3,000 you can deduct every year against your ordinary income, and that's your max carryover. But
Yeah, if you decide this is just too much work and you want to have somebody manage it, ask him or her, do you personally manage the money? And this is one point that's very big, because as we look at our portfolios on a regular basis, we monitor them and see if we need to rebalance it. But if there was a tax significance, I have to check that off that I talked to the client and that they're okay with it. But a model portfolio at Schwab or Fidelity, they just put it in, they're gonna do whatever the portfolio decides to do. And what's the point? That's ridiculous. They're not thinking about it. So that's another reason to do it yourself, or if you have somebody else do it, make sure they're actually managing the money themselves. The daily stuff we mentioned, but there's other things, proposed tax law changes, property tax, inheritance tax, capital, all these things. The step up in basis where you inherit something tax-free, that was almost gone a couple of years ago. So they're coming for your tax write-off. So at least be aware of a lot of these things. And then that Prop 19, was it? Changed things that if you leave a house to the kids, they use it as a rental, they're gonna get an assessment on property taxes and they can move into it. It's not under $1 million. Something to watch YouTube videos about, listen to CPAs, attorneys, financial advisors, or have somebody do it that's gonna watch out for this stuff. But these are a lot of the things that we need to stay on top of. They also tried to eliminate 1031s, exchange on real estate to defer or eliminate, defer taxes. Weekly, like we mentioned, list of funds held, but you're looking for change in management, expense, regulatory issues, and so on. Then monthly, as we mentioned, we're gonna listen to good podcasts and things like that out there. There's that one, ETF Prime is a podcast. If you're into this stuff, if you're an ETF geek, ETF Prime is something you want to listen to. They have great conversation. And if you're really into ETFs, ETF.com, you can search out ETFs there. But you'll get some good neutral ground where you're not being hustled to buy something. Replacements, that's what we said. Are there new ETFs that are better or something you like more or lower cost and all that kind of stuff. Then we mentioned on a quarterly basis, we evaluate everything, look at the allocations and all that. Past performance, lowest to highest and things like that. We'll run a column of funds. The biggest up here, the smallest down here, the highest expense up here, the smallest down here. If there's star ratings below 3, then it's like, yikes, let's find out what happened to that fund. So Morningstar might drop that. And we just reevaluate those on a quarterly basis. Monthly, we go shopping. Quarterly, we evaluate and fire some of the funds if they don't look good. And then, like we said, the next one, on biannually, you're just going to look at a change of allocation. You may want to reallocate the portfolio, maybe not just because one fund's up too much, but maybe everything's up too much in equities and stocks because the stock market's up. I'm a little worried. I'd like to sell off some and move it back down. But it's all relative to how soon you're going to need to liquidate shares and live off them. So it's the time frame. Obviously, there's other things like expense ratio, risk, and all that. But regardless, it doesn't matter until you go to liquidate money or look at your statement and freak out. Okay? And we need to stay away from freaking out if we're properly diversified in all the areas that are important to you. If you like low risk, then it should be low risk. But I have some people that, one I talked to recently, mom's 103 and the daughter called. She said, well, what, we're not making that much. This is, why do we have all these bond funds? Well, when mom was able to come in, she wanted short-term, I put her in short-term, ultra short-term bond funds so they didn't drop much, but she didn't earn much, 2%, 2.5% when CDs paid 0.1%, right? Now she's getting 4.5%, 5.5%. But she did stocks, her and her husband, because they have a good pension. We like stocks. So you want to look at the allocations and make sure everything's still in range for you. Now, if mom passes at 103, then we'll reallocate the portfolio to mostly stock funds for the daughter. But for mom, she didn't want to take the ride of the stock market, all stressed out. So what's right for one person isn't right for another. So biannually, but the main thing is if something's overweighted or up too much, then you might rebalance that or sell it. The annually, like we mentioned, the cash flow, insurance, estate planning, tax planning, investment quality, and portfolio allocations. And then review current risk, change in income needs, and change in objectives. You might need more money. This lady said her mom needs more money. Okay, we had some municipal bonds in there, but because mom has a lot of these medical deductions exceeding 7.5% of their adjusted gross income, she can use those deductions. Then we are rebalancing the municipal tax-free bond funds into taxables, and we're getting 5% plus. And now that'll help mom, and she can write off some of the income. But we need to understand that cash is for immediate liquidity, bonds is for immediate and long-term income, and give you some balance if the stock market drops. But you don't make a lot of money in bonds, you just keep your money in bonds. And then stocks, you don't lose it unless you sell it, but they're there for, I would say, 7 years plus, 10 years plus. You can always get in and out of them. Stock market goes up, you can sell, or if it stays the same, you can sell, but obviously if it falls, we'll wish we had some diversity. Annually, let's see, okay. Post-planning administrative stuff, boring, page 185, but if you do these wrong, you'll have some problems. You'll have accounts that if you have an individual account, all by yourself, just your name on it, what's the problem with that?
Okay.
If you died, right? So, family has to go to court and say, wait a minute, that's our money. Well, their name wasn't on it as an owner or a beneficiary. There wasn't a trust that owned it. So the bank can't give the relatives the money. The relatives have to go to court and get a letter from the judge to say, yes, this is a court order, give these family the dollars. And obviously that takes time and expense, and that's very stressful. Then there's transfer upon death, so that's kind of like a beneficiary provision. You can put somebody on your bank account, your brokerage account, even your real estate now as a transfer upon death. The good thing is that person would get it right away. The bad thing is, what if they're not responsible with money? And if they're not, then you need to set up a trust so they don't get the money, they just get the income. Then there's joint tenancy with right of survivorship. If you own it with somebody and one dies, the survivor gets it all, right? There's some tax issues with that, right? If I own something jointly with a spouse in joint tenancy, and we bought this house 30 years ago for $100,000, now it's $1 million. Well, if one person dies, the surviving spouse gets his or her half all tax-free. But if that surviving spouse sells the house and has gain above and beyond the original half of the cost and half, $250,000, all that stuff, if there's gain, then that survivor pays taxes on trying to get out of that house. But if they owned it in, there's another one, community property, or I think joint tenancy would, no, that's a different, I'll come back to that. Community property, then if one spouse dies, both cost bases are raised up to the full value and there's no capital gains tax, right? So if you have an appreciated asset that's gone up a lot and you have a spouse, then that person needs to be on there and you need to own community property or in the name of a trust that will claim that right. So community property if it's a legal partnership marriage. The other one I skipped over was joint tenancy with right of survivorship per stirps. Are you familiar with that? It's if one person dies, the other gets it. I don't know how this works, but it's a joint tenancy. Oh, okay, this makes sense. Joint tenancy, brother and sister. They own an asset. One dies, the other gets it, right? But if the one that dies has family, this per stirps, if anybody knows what that means, says that that person, they're not going to leave it to the surviving brother or sister, they're going to leave it to the family. Have you seen that?
Yeah, it's something we learned about in real estate school, and it never applies to us because we don't, we don't help people take title of that.
Yeah.
So it's,
Yeah, you're not allowed to tell them what to do.
exactly. So you learn about it in theory.
Yeah. So joint tenancy, brother and sister, brother dies, sister inherits the property, but if brother had a family and they held it in per stirps, whatever that means, then the brother dies, the sister doesn't get it, but his family members get it. That's what kills me in these law classes, per stirps. You go back 200 years
You'll
ago.
find the
Yeah, it
precedent
makes sense.
someplace there.
But nowadays, you can look it up with Google or YouTube. This is amazing.
Yeah.
I mean, it's amazing. I feel so smart now because you're not sitting on Saturday listening to YouTube about per stirps. I did, so now I'm brilliant. That's cool, because when I was younger, I had dyslexia and I thought I was dumb and couldn't do all this stuff. And now it's like, I'm smart. But it's just a volume of information, and whoever focuses the time on it. If you're into this stuff, focus on it, do it, and then share the information with relatives, family, and friends. And pass it on. They need it, because there's a lot of things that they'll miss. Tenants in common is kind of like family members. Let's buy a condo in Tahoe and we all own a percentage of it. I can leave my percentage or sell it to somebody else. Not a good deal if all of a sudden brothers and sisters own a condo and one wants out, they sell it to a stranger down the street. Now there's a new shareholder. That's not always looked upon as desirable. Special needs trust we've heard about. Monitor your account security. We all hear about this every day. Fraudulent transfers, computer hacking, and all that stuff. We had a client text in, I'm gonna buy my son a car, send me some money. Don't do it, I'm not gonna do it. And so we called and couldn't get her. We're not doing anything, right? We have to talk to the person and pre-AI faking voices, because our clients aren't famous to do that, but someday it'll be a known thing. But so we don't do anything. We're calling her. Last I heard, we're still trying to get a hold of her saying, did you send these emails? And okay, if you did, no problem. She canceled the deal, we're not doing anything. But if she did, we got her voice on the line, the most we would do is transfer it to our bank, and then she needs to walk in person and say, okay, it's me. But watch out for all this stuff, and watch YouTube videos on how to secure all these things. It just blows your mind, all the things that they can try to get in. The banks are responsible for protecting you to an extent, but if you make it so easy for somebody to steal your credentials, they might not. So you want to be careful with that. Business accounts, checking, savings, those are not guaranteed like personal accounts are, right? Because you could have an employee get in and steal the money, the bank doesn't want to have that liability. And the federal laws are personal accounts are guaranteed, businesses are not. So do whatever it is that you need to do on protecting the accounts. Manage the allocations of funds to be used for required minimum distributions when that day comes. So the new age is 73, you have to start drawing, and then there's another age of 75 for really young people or something, I don't remember what that was. But when that day comes, whoever you're working with, you'll get a letter saying you're approaching that age, you need to start thinking about doing it. Now let's say you're younger, let's say you're 40, 50 years old, you've got a 401k, you just got laid off. You need some money out of your IRA. But if you go pull it out, you're going to pay 10% state, 2.5% federal penalties, plus it's all taxed. One exception to that is if you have a lot of money in your 401k or IRA and you need some income, you can calculate something called a 72T distribution. And that says that you can go in, fill out the forms, and say, I need income now. And they'll calculate your age. So there's like 3 different calculations. And they will give you a distribution from that IRA over a minimum of 5 years. Let's see, until you meet, you have to go at least until you're 59 and a half. And if you were 58, you have to go at least 5 years, 3 years past that. So there's catches to it. But a lot of tennis players have made a lot of money and retired early, and I want my money. Okay, then you can do the 72T calculation that says, we're going to annuitize your money, base it on your income, and you can pull out a little bit of money each month. But if you're like 40 years old, you have to keep doing it beyond 59 and a half, or you get massive penalties. It is taxable, but you avoid the penalties.
Kind of a non sequitur, who determines and monitors your required minimum distribution?
They have calculations that each company will determine.
Oh, so your company, your brokerage does that?
Yeah. Yeah, or do they?
I don't know.
They get a letter. My staff calls the client, confirms everything, because there might be 3 different calculations that you can choose from. And you might have 3 different IRAs. Well, it's easier just to draw the minimum from each, but.
It would be the plan administrator or the IRA custodian.
Okay, so whoever that is. Usually if you have a Schwab IRA, then they're responsible to send out the letter and let you know.
Gotcha.
Right?
Gotcha.
And then we respond to that to say, we have to get prepared, because you can, what do? You can pull it out at the end of the year in which you pull the term that age, right? Or you can start pulling out anytime you want.
Right.
So if I'm 73, I'm not, but when I'm 73, I'll be 73 August of the year. I have to pull out that year's required minimum distribution at any time during the year, right, based on the prior year's value.
Okay.
Most people say, oh, I don't want it, I don't want it, I don't want it, and then December, oh, okay, give it to me then, right? You're taking a risk that the market could be down a lot if you're mostly in stocks. But then, it's a hassle to get money each month, or you could say, my 401k IRA is all conservative stuff. I'm going to start taking my monthly distribution, send it to the bank, withhold taxes, or send it to my brokerage account, and there I'm going to invest every single month in the stock market. That's a strategy you could do if you want to. But if you have all stocks, you run the risk of, boom, the market tanks, and now you got to pull the money for you. Yeah. Remember back in COVID, the government came out with a waiver for a year that you didn't have to take minimum distributions. Any reason why they do that? Market was down, and you would have less shares. You'd have to pull out more of shares to do that, assuming that people had nothing but stocks. A properly allocated portfolio, we would have been just fine, because you would have had some in cash, no volatility, some in bonds and balance funds a little bit, and then you leave the stocks alone. But the RMD, there's so many different variations of what you can do.
Yeah, right.
Yeah, and so if you do it, research it, website, and go on to all the videos and things and find out which one meets your needs. Also, let's say you pay off your house, what do you do with that $1,000, $2,000 a month? If you've always felt like, I never got into the stock market, well, I wouldn't recommend jump into the stock market. Who knows what happens? It tanks, and 10 years later it recovers. But if you're not paying that house payment anymore, that can go into the S&P 500 fund every single month. Then you average out the price, and you say, what do I care? That's what I was paying on a mortgage payment. So if you're not paying a mortgage payment and you can do something with it, dollar cost average into something. If you do an RMD and you absolutely don't need it, you could donate it to charity. Can you do that, Nash? RMD?
Yes.
Okay, you could donate it to charity. Are we a charity?
I wish.
1973.
Darn.
Full day.
Yeah. What I plan to do is, well, just hire another employee or do something, spend the money in the business that's deductible. But still, when it comes out, depending on your situation, the main thing is how stressed are you when the market goes up and down, and how much time do you have to recover. We call our clients when the market tanks big time. We call and say, hey, guess what? Market's down, everything's great. You're down 10%. What? That's terrible. The market's down 25. Oh, well, that's pretty good. I did better than them. It's a psychological place, right? I call them when the market tanks and prove that because of the research that Nash was telling us about historical standard deviation, not that it's guaranteed to repeat itself, historical beta, historical Sharpe ratio, and the non-correlated, negative correlated, all these different things, because we have this great diversity in this portfolio, the market dropped 25, we expect to be down 10 or 12. Now, when it's up 25, we're up 10 or 12. You have to accept that. But it's like a balanced diet. We've got to be, if we put it all into one area, it's either going to be really good or really bad. The risk is a little bit too great for us at that point. Update registration. Take a look at all your registrations and things and make sure they are what you want. Desired beneficiaries. I lost 2 family members, 3 in the last year, and 2 of them were in their 50s. Now, it was lifestyle choices, but still, things can happen. So they were my down the line contingent beneficiary, so you change that. Then distribution of beneficiaries. If somebody gets older and starts having medical or mental issues, you don't want money going directly to them, right? I have one lady who lives with her son. He has mental issues. He's been in prison and had all kinds of problems and not getting better. So her trust leaves her other son as the trustee, and then the one with problems, he just pays the bills. But we need to be aware of that if that's a concern. Set up education funding. If it's not for our personal children, maybe somebody else's child, I'm sure they'll like you for it. Neighbor's child, right? Learn about all those different things, student loans and all. Oh, student loans aren't a problem, are they? Now, let's just rack them up, government will pay. Research tax information, like we said, set up new accounts. When you're setting up new accounts, just be aware of the registration and all that stuff. I'm not allowed to take in small clients anymore because Nash's mother does the administrative process. And normally, oh, you got 5,000, 10,000, no problem. No, it's a lot of paperwork. We'll send them to Vanguard, and then when they get big enough that they want us to manage it, we can do that.
What's big enough?
What?
Absolute minimum's about 250,000.
But we'll coach people along the way. After this class, come in and see us, show us what you're doing, and if you say, look, I want to do my own thing, we'll give you some ideas. Or if you've got a small amount, we've got a couple funds at Vanguard we like that we'll send you there. Or if you don't want to bother with all the details, then you can talk to us later. We have clients, one that came in after a class from 2019. I've had clients come in after 20 years. It's not a matter of can you do it or not. You can do it, but do you want to spend the time? That's why older people are a pain in the neck. Oh, this is too hard, Nash. Can you figure out how to do this website? Ha ha ha, I'm just too lazy. And then he can figure it out and focus on it. But all this stuff, it's kind of like when younger people look at you like, well, it's just another website. Well, can you imagine if you had to go to the DMV and register your car every week? That's what it feels like, a new website. Go to our website. They're so proud of it, and it takes you 3 hours to figure out how to use it. Rolling over outside investments, avoid. So if you roll over money from an old 401k to a Schwab Fidelity rollover IRA, it should go in and of itself or be combined into another, what we call a ERISA protected plan, meaning a full-fledged retirement 401k, thrift savings plan, something like that. You don't want to roll over your 401k into your little side IRA that you added to and got little deductions each year. That will lose its liability protection. Your 401k, if you roll it to a rollover IRA and it stays as a rollover IRA, it's protected. If you get sued and somebody wins a judgment, that's your retirement. They can't take it, right? But if you combine it to a non-retirement plan IRA, it could lose that, and the judge would say, I'm sorry, it's really not going to work here. So that's something to be considered about. And there's a lot of people, hopefully we're not dealing with salespeople anymore, but if you are, they don't look at these things, they just want the money, right? And so you want somebody to step back and think, am I doing this in the client's best interest? We're required to, being a fiduciary. But then, even when we do that, you can miss things. It's very easy to, oh crap, this is going to trigger this, and this is going to do that. But you want a team of people looking at it for your best interest to try to catch something. Like I say, the model portfolios that you might get at the front desk at Schwab or Fidelity or other advisors, I have other advisors that manage $1 billion. They're so proud of it, but they bring the client and they'll put them in the model. Okay, great. Yeah, ask a few questions, put them in the model, put them in the model, and then the client ends up having stuff sold and paying a bunch of capital gains tax. Or the model has all one company's exchange traded funds, and it's just like they're trying to scale up to make as much money as possible. It's like the Target or something like that. So we want to get back to basics. It should be on an individualized basis. If you did work with something, and this is small print, I'll read it. Advisors, he or she is required to verify your investment money origin. So when the bank asks for it, try not to get mad. The government makes them originate and say, where did this money come from? And they're actually expected to drive down and look at your business storefront. I'm not going to do that. But the government expects us to verify that this is legitimate money. And if it's not, and it's drug money, we could go to jail. We look the other way, we could go to jail. And I've been to jails many times. They smell horrible. But fortunately, I had a clean sheriff's uniform. But I don't know that they really do that, but there are people that maybe I'm colluding with a drug cartel or something. And so if the advisor looks the other way or doesn't do their job, they can get in a lot of trouble, the bank especially. So be patient with the questions. The advisor must document and justify the advice given to the client, document and justify why certain investments were sold and why others were purchased. That's really good news and great regulation. Insurance agents, I don't think they have to do that very much, but if somebody's in the investment world, even the brokers that make a commission, they're supposed to do what's right for you. rather than just shift you over somewhere. But they say that, and we see this abuse all the time, right? We saw a client recently that had a big IRA, and some agent put, what, $450,000 in an annuity inside an IRA.
Yes, so they purchased a $500,000 annuity in another IRA.
In another IRA.
Yeah.
But it was still in an IRA, right? Yeah, tax deferred. And so annuities, the only annuity we really like is Social Security, that's great. But other annuities that have markups and prices and agents involved, usually it's gonna hurt you in the long term. The third one, every year the advisor must show why he or she needs to reallocate the funds or leave them unchanged. So if you have a portfolio, we'll have like 12 different funds. I'll go through and we'll look at them and see if the allocation looks right. Is there too much money in this fund? It's grown too much or whatever, all that stuff. But if I say, no, everything looks good, I have to document why it looks good. And usually it's after talking to the client, call, how's it going, annual review, what's going on? Oh, I'm scared of the market, more so than I need to reallocate, or I've got my Social Security, let's go for it, it's for the kids. So that's why you need to talk to somebody that keeps up to date on your portfolio, not some computerized program, because they'll miss all these. But if they don't do anything and they're charging a fee, that's called, does anybody know? Remember the word called churning? Where the broker buy, sell, 1%, 1%. And at the end of 10 years, you have nothing left, except the broker has a new yacht. So they should just sign it over to you, right? But there's something called reverse churning, where if they charge you a fee, let's say 1.2%, 1%, 0.5%, whatever, if they're not doing anything, that's reverse churning. They just got you in the door and they don't do anything. And I've seen clients like that, where they charge a fee and they don't do anything for the client. They need to stay on top of it, because we're more like a CPA now, and we need to justify what we're doing. And if we're not doing all these things, why are you paying the fee? So reverse churning was that one concept. Here's an example of some fees. I think in the lower ends, ours are lower, but if you go to an advisor and they do your financial planning, estate planning, and do portfolio management, they might be paid as assets under management, AUM, and so if you have less than 500,000, it might be 1.2% a year, or 0.10 per month, 1/10 of 1%. And if they're doing everything that you like and the allocations and everything's working great, it's totally worth it. If they're not doing anything, why are they getting paid this fee at all? That's a problem. 1% if you've got 750 and so on. So as this portfolio grows, the newer dollars pay a lower fee, or for example, a portfolio of 1 million would pay 1.1%. Ours is a little bit lower than that, and we do 10% for students that go to our class. It's not just a sales pitch, they're easier to work with. Because I bring up the portfolio, look at this, standard deviation, beta, they go, oh wow, good job. But other people just say, okay, how did I do compared to the market? Well, it's not the same, right? The market's not the same. So, and it's kind of hard if you have bond funds that even were short-term and were paying 2% a year and a half ago, that was pretty darn good compared to nothing. But now that 2%'s not good enough, where's my 5%? And they're starting to upgrade to 5, but at least we dodged the value of it dropping considerably over time. So this is just for fun, but if somebody's got quite a lot of money there, the fees over 4 million would probably be 0.5%, give or take a little bit. These, if you have mutual funds in your statements, these are some funds that are no longer appropriate to hold. In the old days, the A shares, and there are still A shares out there, you go buy shares at Franklin or American Funds or something like that, and a broker sells them to you, you're going to buy A shares and you'll lose up to 5.75% up front.
How much?
5.75. That's the high commission on a mutual fund, A share, stocks. The bond funds charge 4% or less. Now, if you have massive amounts of money, you have $2 million, there will be no commission. You don't pay anything, but they tend to have higher expense ratios too. On average, probably nearly 1%. B shares, those are phased out for the most part. You don't have any commission up front. You see all your investment being invested, but they're charging you not 1%, they're charging you 1.5%, 2% management fee. And if you leave early, you'll lose like 10% penalty, kind of like an annuity. C shares are a little bit more like the fee-based world. There's no commission to get in, none to get out after a year. First year it's 1%. But they charge an extra 1% management fee. So if the management fee should be 1/4 to 1/2, it'll be 1.25, 1.5. That's okay, but there's not enough C shares out there with companies like Vanguard, Fidelity, Schwab. So we just avoided that together. In the old days, transitioning from A shares to C shares, advisors went to C and then they said, to heck with this, I'm going to go fee-based and follow the actual term.
What is the, sorry, what is the class A or B? The quality of the shares?
The A shares charge commissions up front.
It's only that.
Yeah, just them, but they have higher management fees.
But because they have higher returns.
And they can get away with it. They don't have higher returns. They charge you to get in, then they'll charge you 1/4% so they can pay themselves a marketing fee to sell more shares to other people. So yeah, the management fees are usually too high and the upfront commission, why would you pay it?
I think
Yes. And then the B shares are pretty much phased out, but those were done to hide the upfront commission. Oh, you don't pay commission. But if you leave within 10 years or 7 years, you'll have a big penalty. And meanwhile, we'll charge it twice the management fee. And then the C share is, okay, no upfront commission for the most part, no backing penalty, but we'll charge you a higher fee to pay the advisor to manage it. But a lot of advisors just put you in C shares and never did anything again. And they did that reverse term.
Is this ABC categorization, is that something that is like an SEC standard, or is it just sort of shorthand for different, sort of just, this stock is sort of like this, or sort of like this, or sort of like this? In other words, you gave very specific definitions of ABC, and I just wondered, something like if you went to an Securities Exchange Commission website, you'd find those definitions there?
Absolutely, they regulate it, they create it. And it's mostly for brokers who want to make a commission. And it's not the end of the world. If you bought a lot of money in American funds and paid an upfront commission 20 years ago, and it's doubled or tripled in value and there's no more commission, you're doing great. And you don't need the diversity of different companies. But if we were to sell A shares and get paid, one, we get paid up front and we don't get paid for the work we do after that. So it's hard to get excited about that. But you have to stay with that one company. We can't use a variety of companies where we don't want all our eggs in one basket. And so then if we did A shares and say, well, normally you would get discounts on the commissions if you put a lot of money. If you brought in $1 million and do A shares, you probably have 0 or 1% commission. And the company would just love to have the money. They might pay me 1%. But you've got all your money with one company. If I diversify among companies, now you've got smaller amounts where you are going to pay the 5.75. You don't get the discount. So then that's abusive in itself. I want to do all these companies, but I want A shares. Now I've got you small amounts, different companies, full bore commissions. Because the commissions go down as you put in a greater dollar amount. So that's why you want to obviously stay with the no-load, pure no-load funds that are out there. There are some, well, we can go off into the weeds about load weight and all that stuff, but things to consider in selecting somebody to do it. Reputation, obviously run all the checks that you can do. Are they fee-based managers, hourly financial planners, and do they have your best interest at heart? That's the rules and regulations. And if anybody deals with you regarding securities, if you want to hire them to do anything, they're either going to get paid a commission, a fee to manage, or a consulting fee, or an hourly fee. They need to be registered as an investment advisor or associate.
They either have to be registered as an investment advisor or as an investment advisory representative, or they don't have to register if they're dealing in only government securities.
Oh, okay. Didn't know that. So government securities, you can charge a fee and just do that?
Yeah, if you all you did was manage treasury portfolios, you don't have to register with anybody.
Wow, I think I'll do that. I don't do all this licensing and continuing education. Because when you go down here, never work with an advisor you haven't done a background check on, You can go, there's a couple things to the side, questions regarding those SEC's phone number, if that's up to date, sec.gov, but you can also look up something called broker check. And that will give you the advisor's background of licenses, who they've been working with, and if there's any complaints or regulatory issues, violations, or fines.
Licensed federally or by state or both?
Good question. If they can be a registered investment advisor or an associate of one in California only if they have a small practice of 100 million or less. If the home office has more than 100 million, then that'll be federal.
Okay.
But you should be able to find them both.
Yeah, so you can see both federal and state registrations on broker check. Yeah, it's from FINRA, so that's a
Okay.
federal regulatory agency, so you'll see information on both, depending on what it
Yeah.
is, but again, depends on the business size.
Okay.
Yeah, any business you do, CPA, attorney, advisor, but especially this, check their backgrounds and credentials, because when somebody says, well, I'm thinking about going with this other person, or maybe you, the first thing we do, background check.
Yeah. So you could go on like the California Breeze, where you check any kind of license for state level.
Yeah, and if not, there's SEC and
Right.
FINRA and brokercheck.org, and all of those things are in the book. But we've seen things where one advisor had a misdemeanor for assault, and all assault misdemeanors came from a felony, right?
Yeah.
They pled them down.
It broke her down, yeah.
But this is like a brawny looking advisor and a little scary looking, you find out he beat somebody up at a bar. That's on his broker check as a misdemeanor. Or we've seen them where they owed the IRS $200,000. We've seen them where drunk driving. One advisor was arrested for theft that was pled down to a misdemeanor, and he stole some. I mean, it's like, oh my gosh.
Yeah.
And they can still do this business if what they did wasn't related to finance, correct?
It is.
Can they be a murderer person?
I don't know about actual,
Felony?
what SEC says about that, but I know for organizations like the CFP board,
Oh,
they treat different levels of crimes differently. So there's like assumed bad, and then there's kind of, they will always, there are some crimes they'll always treat as you just get barred and you get taken away. There are some where they assume that it's probably they're gonna bar you, but they gotta ask you some questions. And there are some where you'll have to disclose it, but they won't do anything. And then there's some that don't matter at all.
So it's not just that the threshold is felony versus
Right.
misdemeanor, there are finer
Yeah,
shades.
so yeah, it'll again, depends on if you're talking about somebody who's offering a designation that can be revoked or a registration that can be barred, so it kind of depends.
yeah, Nash is a chartered financial consultant, one class over the CFP, and he has strict guidelines to follow. And I, with my licensing and affiliations, have it, but I have a master's degree, but he has a industry credential that they could take away from him if he got in trouble. And misdemeanor, almost all crimes that are related to finance, right?
Yeah, all crimes that are related to securities and finance, those will be immediately like you get barred like that,
Yeah.
but otherwise they won't. They shouldn't affect the registration.
Yeah, they come in to search the office and I play games with them, you're done. You just better but being from law enforcement, I mean, just do the right thing. It's too scary. So if you ever work with somebody, or if you have friends that ever works with somebody, make sure you avoid account churning, buying and selling, commissions or whatever, or maybe they're a fee-based and they're not making any money, but maybe they think they can pick them. You can't pick them long-term. We'll let Morningstar worry about what's a good fund, and then we'll allocate it appropriately. But if I'm buying and selling, oh, get in, get out, get in, that's when they can run you down to nothing, and they have some emotional problem because people lose everything they've got. I know one person, the wife got a call, created a relationship, sent money. Oh, look, we're buying options for you. Your 10,000 worth $8 million, but you need to give us this money to pay the taxes. So just stay away from any massive activity. And when there is activity, we'll contact the client saying, look, we talked to you, your objectives changed, we're going to sell 5 or 6 different funds, you're going to get a transaction notice in the mail. Reverse churning, we're talking about untimely trades, same problem there. If you call, we don't like to do individual stocks because somebody could call, hey, Friday at 3 o'clock, give me another Tesla, give me out. And you can't do it, or it gets lost. And now all of a sudden they're gonna sue you because you didn't get them out and the thing dropped more. So it's not worth the risk. And I would recommend people do it unless you live and breathe this stuff here in front of the screen. Unauthorized transfers of assets, obviously. Anybody that moves money around without talking to you first. If you manage money with somebody that has discretion, you signed a form and they have the ability to reallocate the portfolio based on what? Your risk tolerance and all the questions that we've asked, right? They have to stay within that range. So I got audited by Nash recently. I had a client that said growth and we had something less than growth in a portfolio. He's saying, which is it? Is she growth or is she moderate? So I have to clean that up and say, well, I just talked to her, she's moderate, so we can make that adjustment. He's the first line of defense in being the bad guy, picking on his dad. But keeps you out of trouble. Unlicensed activity, obviously, but there are brokers out there, and you have friends that the broker said, or not even a broker, right? That might be a person that says, I deal in options, give me your money and I'll make you all this money. And obviously, if they're not licensed, and if you have a friend that says, I got this great person, they're gonna buy stocks from me, great, where are they licensed, who are they affiliated with? They need to be affiliated with a big pocket company. So if they do something illegal, you can go and sue the big company and get your money back. But if it's an unknown and they're not licensed, have your friends run the other way. Unauthorized trading, obviously unsuitable recommendation, something that's not suitable. Let's put you in a long-term investment, some annuity that has a 10-year surrender penalty when you're 85 or something. That would be ridiculous. Most of the companies will screen for things like that. Unsuitable tax-deferred redundancy. Put an annuity in an IRA or an IRA as an annuity. It's redundant, right? Or you wouldn't put municipal bonds in an IRA for the tax-free yield. Some exceptions if it crashed and it might rebound, but generally you wouldn't do that, right? So these are just some of the things to think about.